All right, hopefully you've knocked off the long Labor Day weekend hangover and got yourself back into a routine. Kids are back in school, football is on TV all weekend. All is right in the world until next weekend when travel baseball starts back up. But anyhow, we're here to talk about what just happened this past summer. It's always a good time as we head into the next season. Look back at what went on. Dust off your financial plan, make sure that's still on point because we did have a crazy summer. Lots of headlines, the switcheroo and the election. A lot has gone on. We had that April pullback as well as the one in August. And the August one was the sharpest one we've seen in the last 2 years because previous to that, you only thought about carry out, never a carry trade. And just like that, it snapped right back. Now, September started off pretty bumpy start for most of us, not what we want. And September can be a softer month for total return. Look at my post from this week. But with upcoming election, what the Fed may or may not do, and geopolitical risk, and whatever disaster du jour they want to cook up, it's a little bumpy. It can be a little nerve-wracking. But on the flip side, with the softening job market, inflation cooling off, the Fed probably will be cutting on September 18th. With interest rates going down, the economy plugging along, might be all right. But let's be honest, next couple of months, probably be bumpy. But we don't want you to get caught up in the noise, the headlines, and the chaos. Take a deep breath, pour yourself a drink, buckle up, and let's get through this together. Despite some recent market bumps, things have actually looked pretty solid for investors this year. S&P is up 19 and change, at Nasdaq's 18, and Dow 11.5-ish, including dividends. Not too shabby, right? In fact, the S&P 500 has only experienced two notable pullbacks this year, with the largest being just 8%, which is well below the historical average. On the bond side, it's been a bit rockier with high rates, but the buzz around potential Fed rate cuts has helped turn things around recently. So while volatility isn't fun for anyone, especially myself included, it's key to avoid making knee-jerk reactions to the short-term events. With the stock market calming down, investors are turning their focus back to what really matters, corporate earnings. Why? Because over the long term, stocks prices tend to follow the path of corporate profits, which in turn rise along with the economy. Right now, earnings projections are looking good, with growth expected to hit 10% in 24 and nearly 14% over the next 12 months. That is some solid momentum to keep an eye on. Bonds, too, have perked up lately. Bloomberg U.S. Aggregate Index is up 3% year-to-date and has climbed 6.7% since bottoming out in April, when the 10-year Treasury peaked at 4.7%. High-yield bonds have gained 6.3%, corporate bonds are up 3.5%, and treasuries are roughly up 2.5%, thanks to a Goldilocks period of cooling inflation and steady economic growth. Bonds have stepped up to help smooth out stock market swings, showing how important diversification is, especially when the markets are throwing in a few curveballs. So the takeaway, stay diversified, stay focused on the fundamentals, and don't let short-term volatility shake your long-term goals. The Fed is gearing up to start cutting rates later this month after a rapid-fire rate hike spree from early 22 through mid-23, thanks to continued improvement in inflation. The Fed's go-to inflation measure, the Personal Consumption Expenditures Index, PCE, has slowed to 2.6 and only 2.5 when you strip out food and energy. The headline Consumer Price Index, also known as CPI, is cooling off, down to 3.2% year over year, with core CPI dipping down to 2.9%. Sure, prices are still higher than pre-pandemic, but this progress gives the Fed enough reason to shift gears on monetary policy. Now, much of the market's roller coaster ride this year has been tied to changing expectations around the Fed. At the start of the year, investors were bracing for a few rate cuts due to fears of a hard landing. Then, when inflation ran hotter than expected in the first quarter, people thought there'd be no rate cuts at all. Fast forward to now, the Fed is expected to trim rates by about 1% by year end. Each of these twists triggered market shifts, which goes to show markets can sometimes get ahead of themselves. The smart play, focus on the bigger underlying trends. As for the job market, it's still pretty solid, but the softening signs are there. In July, the economy added 114,000 new jobs, falling short of the 175,000 job forecast. Unemployment ticked up from 4.1% to 4.3%. That's the highest we've seen since the pandemic, though it's still not a worrying number historically. Fed Chair Powell recently addressed this in a speech, acknowledging the risk of the job market, saying, "We do not seek or welcome further cooling in labor market conditions." While the Fed has been laser focused on taming inflation, their sights are now shifting towards maintaining balance in the job market. So what's the bottom line? The Fed is adjusting, the markets are reacting, and as always, staying grounded and focused on the long term is the way to go. With the Fed getting ready to cut rates, market-based interest rates are making their moves too. As you can see from the chart, yields are trending lower, especially on the short end of the curve. And here's the big news. The yield curve is no longer inverted. They didn't ring a bell for that in the financial news. The gap between the 10-year and the 2-year treasuries has flattened recently thanks to the expected path of rates. So what does this mean for the economy and the markets? Earlier this year, some investors were bracing for a 2024 recession, partly because we saw the sharpest yield curve inversion since 1980s. Historically, inversions have been recession red flags, signaling that the Fed may have over-tightened. But here's why this time could be different. The higher short-term yields we saw were largely driven by inflation shocks, not necessarily a late-cycle economic stumble. Now, while nothing's ever certain, lower rates could actually give the economy a boost, especially in areas that are sensitive to interest rates. Think real estate, tech, small caps, and more. Let's not forget about bonds. With rates easing, bonds have started to shine again, helping them regain their traditional role as a solid diversifier in your portfolio. Takeaway from all this, how you respond to market swings is more often more important than the swings themselves. The ups and downs we saw over the summer serve as a reminder to stay cool, stay focused, and keep your eyes on the long-term prize as you work towards your financial goals.